Google just reported best quarter they've ever had, basically. Revenue up 24%, cloud up 82%. They beat on everything. And the stock dropped anyway. Why? Because they also said they're spending about $200 billion this year building AI infrastructure and then more next year. So now everybody's arguing about the same thing. Is Google cheap after this drop, or is the spending the actual problem? Nobody's arguing with a number though, so I built an app that gives you one. Let's just ask it. Here's the app. Let's type in Google. It's going to pull in all the financials, running 5 valuations. Give it a second,
Alphabeting.
and there it is.
Google.
It's on pause. So it's overvalued, around 65% above fair value. So after all that, the beat, then the drop in price, everybody arguing about whether it's cheap now. My app says it's still expensive. Fair value somewhere around 175 to 213. It's trading at around, let's just say 320. And then there's this right underneath it is the Wall Street analyst consensus value at around 428, average target providing by 54 analysts, which is very bullish, and 34% above today. My app says it's worth 194, let's say, give or take. That's the average between 175 and 213. Wall Street consensus or analyst says 428. Same company, same day. That is not a small disagreement. Somebody is wrong here. It might be me, it might be my app. So let's go through the actual math and you can decide. I'll show you how I got that number, where it can be wrong, and the parts of this app that just refuse to answer at all. Okay, quick intro. My name is Christian. I'm a product manager, not a software engineer. I can code. So this app was built by a two-person shop. That's me and my AI developer. I do the product management work, what to build, what's honest, what's garbage, and my developer writes the code. So this channel is me building this app in public, and this app is one of many that I plan to build. But first, the important part, and I mean this is an educational tool. It is not financial advice. It doesn't know you. It runs the same math for everybody, for every stocks, and it can be wrong because the data underneath can be wrong. So nothing in this video is, for you to buy Google or to sell Google or any other stocks by any matter. Please do your diligence, and do your own research. Talk to an actual advisor if you need to before you put money into anything. Okay, now let me tell you why I built this. So the tools out there that answer what is this stock or business actually worth are either $40 to $100 a month, or they give you one number with no explanation and really you're just supposed to trust it. I wanted one that shows its work and one that's honest when it doesn't know or confidence, have the confidence to know the exact answer. And this week, Google handed me a perfect example of why that matters. So here's what happened to me this week. For about 10 minutes, I thought my own app was broken. Now, after Google reported, I looked up their free cash flow, negative, minus 5.9 billion. That's the first negative cash flow quarter Alphabet has ever had as a public company because of all that AI spending. Then I opened my app. It said positive 73 billion. So which one is it? Is my app just wrong? It turned out to be neither. Both numbers are real. Google showed me 1 quarter. My app was showing the trailing year. Same company, two true numbers, opposite signs. And if you have a tool similar to this app with no context, you'll walk away with a confidently wrong picture. And that's the problem everywhere in this space. The headline earnings number did the same thing this week. $9 a share, up almost 300%. Except most of that was in the business. It was a $98 billion paper gain on investments that they hold, stakes in other companies that went up in value. Analysts were expecting around 290. The actual operating business did fine, up 30%, but nowhere near what that headline said. There is a real way to answer what a business is worth. It's called intrinsic value. Ben Graham, Warren Buffett, that whole school, right? You estimate the cash the business will produce, figure out what that's worth today, compare it to the price. Simple idea, but painful to actually do. And the paid tools bug me for two reasons. One, they use the same assumption for every company. And two, when the numbers are messy or misleading, like this week for me, they still hand you one confident number. So I built this thing that shows you both. And you're about to see the feature this exact confusion made me build these apps. The good news is we have shipped it and it's ready for you to trial and to purchase it. Okay, back to Google. Let me actually walk through this app instead of just flashing it for you. Top of the page, you have the price. The price is $319.74. The verdict is overvalued. 65% roughly above fair value, and the fair value range is $175 to $213. It's a range on purpose, not one precise number, because valuation is a range. And see this menu on the left-hand side? That page starts with simple view. Okay? It shows the verdict and the key takeaways only. But if you want to go deeper, and if you want to, you can click the see the full breakdown, and it will break it down for you further. Now let's jump into the financials via the menu. Now this is the feature that I was talking about, the history block. Quarterly bars, you have free cash flow, revenue, EBITDA, green, 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 right? And then that green. You see one red bar in the free cash flow, minus $5.9 billion below the zero line. This is Google's first negative cash flow quarter in company history. Now you can see the AI spending punching right through it, right? That whole $200 billion spending argument the market is having. That's it. One picture. And see this amber alert up above? The app noticed it. Annual free cash flow is positive, but most recent quarter turned negative. This is worth a closer look at spending. It flags it instead of hiding it behind the better looking number. The caption tells you how fresh each number is. Prices today, fundamentals are from the last reported quarter, so you're not sitting there wondering if the data is stale. One thing about our design here is that the verdict still values the business on the full year number. One heavy spending quarter shouldn't make a company like Google gushes cash look like it's dying. The chart gives you context, and the math stays sober. Now let's go to the valuation methods. Now this is the part I want you to actually look at because it's the most honest thing on the page. We have 5 models and they do not agree with each other as you see it. You have 20-year cash flow, says 125. The 10-year free cash flow says $71. Discounted earnings per share says 425, and the price to sales growth is 363. 71 to 425, that's the spread on the same company, and that's Google. And honestly, a lot of tools out there would pick the one they like and show you just that. This one shows you all of them, weights them, and lands on a range of 174 to 213. And it tells you which model it thinks fits the best and why. For Google, it picked the 20-year cash flow model because Google is a cash machine with a long runway, so a long horizon makes sense. Now, here's the honest version of what that means. If you weight those models differently, you get a different answer. That's not a flaw in the tool. That's what valuation actually is. Anybody handing you one confident single number is hiding this from you. And that matters a lot this week because the whole Google argument is a cash flow argument. 200 billion spending out now, cloud revenue later, right? That trade-off is what these models really are chewing on. Let's go back up to the analysts' consensus line around the verdict. And it brings me back to the thing I opened with. Wall Street analyst says $428. This says 194 average. I'm not going to pretend my app is smarter than 54 analysts. It might not be, but I can tell you exactly why they're different because you can see the assumptions. This model is pricing the cash the business produces today and growing it conservatively. 8% for 5 years, then 7, then 4. Analyst targets are usually pricing what the business might look like if the AI spending pays off. But both of those are opinions about the future. Mine is just written down and where you can see it and change it. Theirs isn't. That's the whole difference. Here's the price line against a fair value band. You can see where the drop moved it. Key takeaways, plain English, based on the actual numbers. The divergence shows up here too. And let me just read it out loud. You can do this by pressing the play button in the voice menu down here.
Current price $319.74. Our analysis shows the stock is overvalued, with a fair value range of $174.04.
Now let's type in a new ticker, a different one. Let's look for, let's just say Netflix. And look at that.
Inc. Ticker NFLX.
Look at that. A different one, different answer that Google got. And that's the whole point. This isn't a machine that calls everything expensive, right? And it's not a machine that calls everything a bargain either. It ran the same math on a different business and got a different answer. Sometimes the honest answer is boring, but it just says it. In this case, for Netflix, we're under fair value. All right, let's type in another ticker. And we'll look for SPY. This is the part that I'm actually proud of. As you can see, It says SPY isn't an individual company we can value, right? SPY is the big S&P 500 ETF, a basket of 500 companies. The app refuses to answer, says this is an individual company or it's not an individual company we can value because it isn't. Running company valuation math on a basket of 500 stocks is meaningless. Most tools would just spit out a number anyways. This app knows what it can't do and what it can do, and it says so. Next, let's type in SpaceX, SPCX. SpaceX is a recent IPO, and the public data on it, it's still rough. And that's how it goes for most recent IPOs. Now let's wait for a second and then watch.
Space Exploration Technologies Corp.
Again, it doesn't give me a number. It flags the whole thing unverified. Okay, the revenue, the source reports doesn't reconcile with the share count and the price. Any fair value built on this is built on garbage. So it stops, marks it provisional, and offers to flip the map around. Here's what the numbers would have to be to justify today's price. Now, honestly, I spent an embarrassing amount of time on this behavior. And again, most tools out there would have just lied to me confidently. All right, so one more thing. Let's go back to Google.
Alphabet Inc.
And let's go to the override panel, where you can adjust the inputs here. You can think you think growth should be more conservative. You can change it here. Hit recompute, and it runs everything again with your numbers labeled as yours. What I'm trying to say is this is not a black box telling you what to think. You can argue with it if you want. The expensive tools out there don't let you do that. All right, let me pull back the curtain and let's talk what's under the hood. Let's talk about three things. One, you type a ticker, it pulls the real financials, and it checks the price against a second independent source before it trusts anything. Because data lies sometimes. You saw what happens when it can't verify. That's the SpaceX banner. Second, and this is the best decision in the whole build, the AI and the math are separate. The AI does the judgment. What's a reasonable growth rate for this company? Which models fit? Writing the summary. It does no math because I learned the hard way that AI is bad at long chains of exact math. At one point, mine was off by 100x. The number crunching runs in normal. Boring code that does the same thing every time with automated tests proving the math is right. So the AI is the analyst who hands you assumptions and a write-up. The calculator is a separate boring machine that does the multiplication. Splitting them made it more accurate, cheaper to run, and testable. Okay, to the boring part. But building in public means being upfront about the business too. So as of this week, this is live, techdimentals.com. It's a real site, real accounts, and real payments. I watched the first $10 that came through Stripe, and I'm not going to pretend that wasn't a moment. But here's how it works. You sign up, you get an email notification, you verify your email, and you get a free 3-day trial. One full analysis a day in each of the apps. Enough to actually try it. After that, it's $10 a month for a Pro Unlimited version. And I want to be straight about why there's no free tier. Every analysis costs me real money in AI and the data. Free forever would bankrupt this thing before it gets good. $10 is a fraction of what the other tools charge for less honest output. If 3 days isn't enough for you to decide, don't pay me. That's the deal. Now, here's why the timing this week is kind of perfect. Google was the first domino. Now, Wednesday, Microsoft and Meta reports. Thursday, Apple and Amazon. And every one of them is facing the same question Google just got hit with. How much are you spending on AI infrastructure, and is it worth it? So as those reports land, I'm running all of them through this app. The full Max 7 spending scorecard, side by side. Who looks cheap, who looks priced for perfection, and who the model won't bless. That's the next video. It drops after Thursday's report. Now please subscribe to the channel if you want. Now one more thing before I go, because I haven't shown you half of what you're paying for, right? I didn't mention the other app called Reader. Now the name, Techdamentals, that is not random. Technical and fundamentals combined. Two words jammed together because that's the whole idea. Two apps, two halves. What we just did with Google was the fundamentals half. What is the business worth? Now this is the other half. It's called Reader. Watch. Now here's a trick. I didn't screenshot just one chart. I grabbed my entire trading platform layouts. You have the weekly, the daily, the hourly, and also the 5-minute chart. Same stock. I'm not typing a ticker. I'm not telling it anything, just a picture. Okay. And it's bearish. Price action favors downside continuation. And look at this down here. If I click on the see full breakdown, it found all 4 time frames and read them separately: weekly, daily, hourly, and 5-minute. Then it tells you they're all pointing the same way. No time frame conflicted, which it says usually means a stronger trend and not a choppy one. The levels up here are in the 408 resistance level, 364, 355 at 345, and where the current price is at 319.74. Now keep these in mind. The recent low support 314, these two, especially the weekly support and the deep support between 185 and 211. The hint is, what is our fair price for Google and what we got from the IV calculator. Let's go to the candlestick patterns. You have the shooting star topping wick, where it found it in the daily chart near 376 and 378 area. You have the doji indecision candles in the 5-minute chart as well. Now, if we scroll down, we will find the ICT, or the smart money concept. If you like to invest or trade this way, it's all named here. Break of structure, you got the order block, fair value gap, liquidity sweep, and this one I really care about the most, which is the price volume signals, or what people call volume price analysis. And if we scroll up all the way up to the bias again, you can see the anomaly, divergence, in this case price reach a new high of 408 on elevated volume before reversing sharply and accelerating lower. The classic effort versus result mismatch, where the breakout to new highs produced no sustained follow through, suggesting the high was a liquidity sweep or distribution top rather than a genuine breakout. Now that's a real volume read, not a pattern name. Now here's the part that I want you to see the most. Before it read anything, it grabbed my screenshots, right? Chart quality notes. It told me putting 4 charts basically in one image makes the candles harder to read. It told me the 5 minutes volume is tick volume only, so volume analysis on that panel is less reliable. It also told me that the prices labels are compressed on a small chart, so the levels are approximate. It critiqued me. It critiqued my own input before it gave me an answer. That's the same data as a valuation app refusing to value an ETF in the IV calculator app. So a tool that tells you where it's weak is a tool, in my opinion, is a tool that you can actually trust. And finally, here's the thing that I did not plan. I only noticed it while after doing the analysis on both IV calculator and the reader app. Keep the, remember what I said to keep these two weekly support in mind, 185 to 211. So 185 to 211. If we go back to the IV calculator, right, and type in Google again,
Alphabeting.
you will see that the fair value range is 170 between 174 to 213. Now that could be a coincidence. I want to be careful here. One example doesn't prove anything, and I'll be testing this properly in future videos, especially with the Mac 7. But this is exactly why I built two apps instead of one. Technomentals, technical analysis, and fundamental analysis combined. When the business math and the price action point at the same price, that's worth knowing and flagging and evaluating even further. And no tool I found will show you the both we're showing you today. Two apps, one subscription. That's why it's $10 a month and not 20. So my ask, and it's small, if this looked useful for you, and if you ever stared at a week like this one and wanted a number instead of a shouting match, comment early access in the comments section below. And the first 25 people will get a 20% discount for the first year. Now the trial is free for 3 days. No need a credit card to start it. And I'm keeping that in the comments because you were here first, and that matters to me a lot. So the first 25 people, please comment early access below, and that's real. And don't forget to like and subscribe this video. That helps a brand new channel like me or like this one uh, way more than you think. And Wednesday, the next dominoes will fall, right? Microsoft, Meta, Apple, Amazon. The scorecard's coming. So please subscribe and like the video. And one more time, because it matters, this is an educational tool, not a financial advice. Nothing today was to say buy any stock like Google or sell Google. Please do your own research. Thanks for hanging out, and see you after earnings.